This is a big crowd, and appreciate your attendance. My name is Hap Burke. I'm a real estate lawyer here at Thompson Coburn, and our presentation today is going to be on the new Dodd Frank Rollback bill. This should be good news for everybody, and that may be why we've got such a nice crowd here. I want to introduce our presenters today, Gayle and Greg. I want to mention one of the great things about working at Thompson & Coburn and practicing law here is that we get to work with really smart and talented and accomplished lawyers, and these are two of them. We have a regulatory lawyer and a transactional lawyer, so you're going to hear details about the bill itself as well as some practical tips about structuring loans. Greg Omer is a bank regulatory lawyer. He's a graduate of Duke Law School and has his undergraduate from Mizzou. He started his bank regulatory career as chief counsel for the Missouri Division of Finance. He's currently a member of the Missouri Bankers Association and the Conference of State Bank Supervisors. He's chair of the Missouri Bank Regulatory Reform Task Force and vice chair of the ABA's State Banking Law Subcommittee, and he was previously chair of the Missouri Bankers Association Legal Advisory Board. He's widely published and speaks a lot on banking topics. Gayle Smith is a real estate and finance lawyer, and she's vice chair of our real estate practice group. She's a graduate of St. Louis University Law School and Mizzou undergrad as well. This year alone, she's closed over $200 million worth of loan deals, including senior living facilities in Ohio and Missouri, car dealerships in Illinois and Indiana, retail projects from the Midwest to Florida and Michigan, multifamily projects and mixed-use facilities throughout the Midwest. So this is the background for our speakers, and unless we have any questions, we'll turn it over to them and let them get started. Thank you, Greg and Gayle.
Yeah, thanks, Hap. Is the volume okay?
Yes.
Okay, good. Thank you, and thanks to everyone for coming out this morning. We're gonna go over a topic that's known as high volatility commercial real estate. It's a concept that was initially put out during the financial crisis. You may remember in 2008, that's when the crisis began. We had a major law come out in 2010 called the Dodd Frank Act, which was much to the chagrin of most bankers and probably a lot of people that dealt with bankers. And a lot of reforms came out of that. One of them that was not popular with bankers was this HVCRE rule, high volatility commercial real estate. And so we're going to talk about what you've been living with for the past few years under the Dodd Frank rule and how a new law that was just passed this summer is going to impact that and change some things for you. So first of all, again, the acronym's HVCRE. I'll say that over and over again because it's hard to say high volatility commercial real estate very quickly. And just so everybody gets the background on this, this whole issue comes up out of what's called risk-based capital rules that Dodd Frank required. So the idea of risk-based capital is that every bank has a balance sheet with assets on it. The banks typically have primarily loans there. And risk-based capital rules categorize those loans. So there are high-risk loans and low-risk loans. HVCRE is just a category of high-risk loans that the regulators laid out after the Dodd Frank Act in a reg. And so that's where we start with this. Just so you understand what this means, it means that if you make one of these high-risk loans, that is HVCRE, the bank that makes the loan has to put back extra capital. So there's an extra cost to the bank. It's actually 50% higher in the capital contribution the bank has to hold for an HVCRE loan compared to a non-high-risk loan. So that's important to understand because it affects costs, not just for the bank, but for the borrower too. As we move ahead, we'll talk a little bit more about how the risk-based capital rules impact the loans and the way the terms of the Dodd-Frank rule did that and where they're going to change. The main thing, again, is that there's going to be cost. Even if you can avoid the HVCRE category and therefore get out of the high cost on the bank and passed on the borrower's side, you're going to have to hit an exemption. And so under the Dodd-Frank rules, we had exemptions to avoid HVCRE status, avoid this higher cost. But the exemptions also cause some compliance headaches because the regulators will tell you if you want to be exempt, if you're going to do commercial real estate loan, you're going to have to do certain things. One of them, for example, was require the borrower to hold capital to keep the exemption. And that's one of the big things that Dodd Frank required that was problematic. And before I jump into the definitions under Dodd-Frank specifically about what is HVCRE, a couple things to understand that this isn't. This is not the government saying you can't make HVCRE loans. It's just if you do make them, they get this higher capital treatment. It's also not the government telling borrowers you have to have certain amounts of capital. It's just telling borrowers if you want the exemption, you'll have to meet these capital requirements that Dodd-Frank had set out. That can practically lead to the same result because the banks will try to avoid the higher capital costs and the borrowers will have to meet the capital requirements that we have. We also want to make sure that you understand that just because you avoid HVCRE status doesn't mean that the loan will be a very low-cost loan. You may still have other reasons that rates and fees can be higher that are outside HVCRE. So as I mentioned before, we've got the existing Dodd-Frank rules. They're actually still on the books. If you look it up, all the Dodd-Frank rules are there. The regulators just haven't had time to change them yet. So a new law was passed in May, late May this year. That law had a section that directly addressed HVCRE and changed what the Dodd-Frank rules had required, what was defined as HVCRE. The main point was to clarify the definition, and then secondly, to provide some new exemptions. So that law, everybody would probably want to know this. Is it effective now? It is. It was effective when signed, which was, I believe, May 24 by President Trump. So as I said, the Dodd-Frank rules are still on the books, but you also have the statutes on the books. So we've got conflict right now. And until the regulators can update the rules, we'll have provisions that don't exactly match as we go ahead. We don't have much guidance yet from the regulators about how that interplay between the Dodd-Frank rule and the new statute is going to work. We did get some guidance in July, and it was really directed at banks on call reports. And what it said was banks can use the new statute terms, which we'll talk about in a second, to classify their loans as HVCRE or non-HVCRE. They can use the new statute if they have the proper information to do so. So, for example, if you've done some due diligence on the loan, you know that it will no longer be classified HVCRE, then you can do so, document your file, and follow the new statute's terms. Alternatively, if you don't have the due diligence to back up the change in status, then you can use the Dodd-Frank rules. And that's really the only guidance so far. I would say to everybody on the background part of it, stay tuned. We'll probably see informal guidance. We will certainly see a new regulation coming out soon. And Thompson Coburn, I'm sure, will be issuing guidance of our own about what's out there and how this changes as we move ahead. So let's go to the Dodd-Frank rules that are out there, still out there. This is what you've been dealing with for the last few years. HVCRE is a loan that finances or has financed acquisition, development, or construction of real property. So you'll notice that the word has financed, the phrase has financed is used. It's past tense. So a lot of people would say, why are we talking past tense here? It's because when the regulators put this reg out, they figured if an asset is on a bank's balance sheet, we don't care when it was made. It's a high-risk asset. So it could have been made 10 years ago. We'll still call it HVCRE for purposes of this Dodd-Frank rule. This is something that's changed in the new statute. But under the Dodd-Frank rule, it was completely retroactive. No matter how long before the reg went in place, the loan had been made, the rule still applied to it. If it fit the definition of HVCRE, it was HVCRE. The second component of this definition is that the loan hasn't been converted to permanent financing. That phrase is not defined in the reg, but generally it means meeting the bank's underwriting standards for a permanent loan that you would typically have. There are a few exemptions that the Dodd-Frank rule set out, and in addition to changes in the definition, we've got changes to the exemptions. So the three basic exemptions we had was a loan made for 1 to 4 family residential purposes could not be HVCRE. A loan made for community development investment purposes also could not be HVCRE. And keep in mind that phrase, community development, is very restricted. That's a bank regulatory phrase. Very few loans will fit that. And the last one was agricultural land. All three of these are roughly the same between the Dodd-Frank rule and the new statute that came out in May. So these exemptions don't change much. The one that does is the one that was frankly more contentious. It's this one. This is the commercial real estate exemption. So this was the Dodd-Frank rulemaker's attempt to create a category of loans that really was commercial real estate, but they thought was safe enough not to be high volatility. Okay, and this exemption I'm going to go through caused a lot of heartburn among the banking industry because it was hard to implement, and frankly, from the borrowers too. So the first category for this definition is fairly straightforward. That's loan-to-value ratios. The regulators had existing requirements for loan-to-value, and an HVCRE loan that hits this exemption has got to meet those standards. Typically, it's 80% for a construction loan. There's a schedule that shows you might fit into a different category, but 80% would be the most common category for LTV. That's the first one. The second one, the second factor you've got to meet is the more complicated one. This is the capital requirement. So this is capital of the borrower. So if a borrower is going to get an HVCRE loan and they want this exemption, they want to get out of it, they have to contribute capital to the project that is at least 15% of the as completed value of the project. This is under the Dodd Frank rule. Okay, 15% of as completed, meaning the 15% of what you think the project will be worth when it's finished, not at the time you start, not when the loan is made, but at the end. There are rules about what the capital has to be. It can be cash, it can be unencumbered, readily marketable assets, meaning traded securities, and it can be paid out-of-pocket development expenses. The regulators gave us some guidance on the development expenses. There's a laundry list of things that they believed counted for the capital. On cash, obviously cash into an LLC or other entity that owns a project would be one way to do it. The other thing the regulators agreed to do was that if you had real estate, which would be, of course, very common, and you want to contribute that, under the Dodd Frank rule, real estate wasn't listed as something you could contribute, but cash was. So the regulators said, well, if you paid cash for the real estate that you are using to contribute, we'll take the cash value you paid for that property. So in other words, if I, under the Dodd Frank rule, if I contributed real estate to this project, I did not contribute it at the value of the real estate on the day the loan was made. I didn't get the appraised value. All I could do was claim what I paid for it, which might have been 10 years before or more. So the value didn't work, and bankers, again, got very frustrated with that because it seemed like if I've got property worth X, why am I getting a much smaller value when I contribute to this project? So those are the forms capital has to be in. The capital has to go in before any loan funds are advanced. That's changed with the new statute, but that was the Dodd-Frank standard. So no money comes out till all the capital is in. And the last one was the biggest one that created probably the most problems, which is that the capital had to be required by contract to stay in the project. So this was talking not only about the 15% that has to go in at the outset, but also very specifically the regulators said it applies to all the capital that's internally generated by the project for the life of the project. So if I put my 15% in and then I see a lot of gain, that gain has to stay in the project too. And the contract, the loan documents have to actually say that in them. So that, again, caused a lot of problems because obviously if a construction loan stayed outstanding for a while, you might cash flow properly and have a lot of earnings. The earnings all had to stay. They couldn't be taken out and used for other purposes. So I'm going to summarize kind of some of the bigger issues that we ended up with the Dodd Frank rules, and I'll turn it over to Gayle to kind of walk through what's changed and what the new statute does. The first, and I've covered most of these just in passing, but the first one is, did the rule apply to loans that were effective before the rule? As I said, yeah, it does. It did. It did because regulators saw it really as just let's classify all the loans on the books. We don't care when they were made. That, again, caused a lot of problems because bankers and borrowers said if we had known what the rule requirements were when we made the loan, we would have structured it differently and got an exemption, but we didn't know because the rule didn't exist. So it wasn't very fair. That was one of the problems. It was also very unclear whether a loan that was not secured by real estate would be covered by the rule or not. In other words, a loan that's made for HVCRE purposes but not secured by that real estate. Did that count as HVCRE? The regulators never really provided guidance on that, and the new rule, again, addresses that much more clearly. Another question that came up that was answered in a way that created problems for bankers was, what if the loan really is only in a small degree applicable to HVCRE? Most of the loan is for completely other things. It's for operating cash or to buy equipment or something like that. Is the rule applicable at all to a loan like that? Well, the answer under the Dodd Frank rules was yes, it is, and you have to treat the part of the loan that was for HVCRE in accordance with the rule. In other words, observe the proper risk-based capital rules. And then the last two kind of go together. You had a lot of bankers under the old rules that had loans that were cash flowing properly and everything was working great. And the question was, can we say these aren't HVCRE? There's no real volatility at all here. We've got the cash flow to make the payments. Everything's good. And the answer under the old rules was no. It's got to stay HVCRE until you take it out with new documentation. So that was another problem. Again, that's changed now under the new rules. And then the last one is the capital one. As I said before, not only the 15% that you put in at the beginning, but all the earnings required to stay in the project, and you couldn't take them out until you took the whole loan out. So those are the things that created probably most of the heartburn. And that brings us up to May. And in late May, again, we passed the Economic Growth, Regulatory Relief, Consumer Protection Act. There's no good nickname for this, by the way. A lot of laws have a nice nickname. You can call it this or that. There is nothing for this. So we call it the Dodd Frank Rollback Law or the Regulatory Relief Act. But it does override the prior rules I've been talking about, as I said, to the extent they conflict. They don't all conflict, but lots of it will. What conflicts, the new statute will govern. And so Gayle's going to talk a little bit about what the new rules say and how they'll trump the provisions of the old reg. And as we move ahead, obviously, the regulators are going to have to incorporate those conflicting provisions into a new rule that straightens all this out. So I'll turn over to Gayle now.
Thanks, Greg. So I'm going to basically just start by going over what the HVCRE ADC loan is under the Regulatory Relief Act. Is the sound okay? Okay. So under the Regulatory Relief Act, an HVCRE ADC loan is secured by real estate that primarily finances, refinances, or has financed real estate. So it has to primarily finance or refinance or finance real estate. And the purpose of the loan is for acquisition, development, or improvement of the property into income-producing real estate. So again, some of these words are kind of, I might be kind of exaggerating them, but it's for purposes of kind of showing the differences between where we were and where we are. So you start out again, just to go over it, it's a loan that's secured primarily by real estate that finances, refinances, or has financed real estate. The purpose of the loan is to develop that property into income-producing property. And the loan is basically dependent upon the future income from the sale proceeds in connection with the real estate or a refinancing in order to repay that loan in full.
So, and just to jump in real quick, so people's antennas should be up when there's just a construction loan, right?
Yes.
Not so much anymore for a line of credit that may have some real estate as security?
As long as that's accurate, yes.
Okay. And then how about things like a renovation loan or something where, you know, a wing is being demolished and something new is being built or something like that?
If the loan is primarily to refinance, finance, or has financed the real estate and it's going to be developing it into, it's going to have future income potential, then that would be considered an HVCRE ADC loan.
Okay. And how, and like, just in refinancing existing income producing property, don't have to worry about it.
We'll get to that in just a minute. We'll go over that. So where are we on here? Okay, so again, it's primarily finances, refinances, or has financed. The purpose of it is to develop it into income producing property, and the repayment of the loan is basically dependent upon the future income that's going to be produced by the property, sale proceeds, or the refinancing. A loan can cease to be an HVCRE ADC loan if the loan is reclassified under the statute. So this is a little bit different than what Dodd Frank said. You had to redocument the loan in order for it to be non-classified as an HVCRE ADC loan. So you have to get some information, and we will talk about this a little bit later as well, what reclassification means under the statute. So let's talk a little bit about the exemptions under the Regulatory Relief Act. As Greg mentioned, some of the Dodd Frank exemptions carry over to the Regulatory Relief Act exemptions, and those include the financing of one to four family residential, community development investment property, and agricultural land. But the Regulatory Relief Act does include a little bit broader or a new exemption for commercial real estate loans. And this is broader than the Dodd Frank. Basically, The new exemption is any financing which is, if for real estate, if the loan to value is, some of it has got some similarities, so it'll sound like I'm maybe being a little bit duplicative as to what Greg had mentioned. The loan to value has to stay within the 80% or whatever the supervisory limits are set by regulators. As Greg mentioned, there is sort of a sliding scale for that, but for mostly construction projects, it's going to be the 80%. The borrower has to contribute capital of at least 15%, and that of the as completed. So that's the same as it was under the Dodd Frank. The capital can be in the form of cash, as Greg mentioned, similar to Dodd Frank, unencumbered, readily marketable assets, paid out-of-pocket development expenses, and it can also be contributed real property or improvements, which is a little bit different from what Dodd Frank said.
Yeah, if I could jump in, that reflects what I was mentioning. The statute actually went ahead and put real estate in as something you could contribute. That wasn't there before. And so now the big difference is, of course, that direct contribution changes how you value that property, and Gayle can talk about that.
Yeah, don't give away the punchline.
I'm sorry, I don't want to step on your lines.
Okay, so just to kind of follow up what Greg said, if the capital is real estate, it's not going to be valued at the purchase price from 10 years ago, as Greg used in his example. It's going to actually be valued at the appraised value at the time of the loan. So that's a huge benefit. You're not going to lose out on that differential from the purchase price and the current appraised value at the time of the loan. The capital that is contributed does have to go into the loan before any loan proceeds are advanced. And this is a new add here, though, other than nominal amounts to secure the lien. Now, Greg and I have discussed this a little bit, and there really isn't any guidance that we've been provided, but what does a nominal amount mean? Does it mean the recording costs that are associated with actually recording the deed of trust, or can it be a little bit broader, and does it include, recording costs, attorney's fees, closing costs, or other soft costs? I think the jury is still out on that.
Yeah, and that's the kind of topic. It's sort of like that other category of development expenses. This is one where hopefully the regulators will give us some guidance about how broad you can go in advancing funds ahead of time and what they consider nominal amounts to get your lien done. Because you could take a very expansive view of that, obviously, and a lot of bankers will probably be asking that question as we move ahead.
Right, so I think we need to stay tuned on that, what exactly that means. Much like Dodd Frank, the capital that is contributed by the borrower must still contractually remain in the project until the loan is either reclassified, until the loan is reclassified or it's paid off in full. Okay, so here are some of the new exemptions that the Regulatory Relief Act created. The first one is for financings that are made before January 1st, 2015. So under Dodd Frank, as Greg mentioned, the Dodd Frank Act did not care when the loan was made. This is putting sort of a start date on it. So any loan that was made prior to January 1st, 2015 does no longer fall within these provisions. So you're good on those. This goes to Hap's question a little bit. The second exemption that is a new exemption is for acquisition or refinancing of existing income-producing property, provided that income-producing property is secured by a mortgage, and that the cash flow being generated by that income-producing property is sufficient to service the debt service on the property as well as the expenses. And those are basically, you're going to have to look at your underwriting criteria for permanent financing to determine whether or not that's actually met. Another new exemption, similar to the one I just discussed for acquisition or refinancing, is for improvements to existing income-producing property. So again, that's provided that there is a mortgage on the property and that property is producing cash flow that is sufficient to cover the debt service and the expenses of the property based upon the lender's underwriting criteria for permanent financing. And then the fourth exemption is any loan that is reclassified under the statute as a non-HVCRE ADC loan.
Yeah, and one point, if anybody's wondering where January 1, 2015 comes from, that's not arbitrary. That's the date of effectiveness of the Dodd Frank rules. So the idea was we'll create a date somewhere in the past and give banks a break and not apply this rule to loans before that. But interestingly, they didn't use the date of the statute. They used the date of the Dodd Frank rule. So that's why we go back in time still from where the statute was.
Right. So what does reclassification mean? Under the Regulatory Relief Act, reclassification of a loan occurs upon substantial completion of the project, and when the cash flow generated by the project is sufficient to support the debt service and the expenses of the property, and it's met under the lender's permanent financing criteria. Similar to what, you see this kind of flow throughout these changes.
And Gayle, that would be a little bit looser than the prior standards, right? The conversion.
Yes. Under the prior standards, there was no really conversion under Dodd Frank. You had to redocument the loan at that point in order to take it out of HVC, in order to, to get it out of those rules or that regulation.
Yeah, it really sort of shifts this to more of a banker's due diligence process. You're really going to be reevaluating loans, as you probably would do in any event, but you're going to be looking at cash flow, looking at where the loan stands at a given time to see whether you can make the reclassification in all these cases.
Right. So some of the issues that were addressed, that were created by Dodd Frank and that are now kind of being more directly addressed by the Regulatory Relief Act, are some questions that we kind of came up with that we think are going to be kind of the frequently asked questions. So I'm just going to kind of run through a couple of these. These are probably questions that are going through some of, if not all of your minds at this point. Do the HVCRE provisions apply to loans made before the original Dodd Frank Act was effective? No, the new HVCRE ADC provisions only apply to loans that were made January 1st and after. So that's pretty straightforward. Do the HVCRE provisions apply to loans made for HVCRE purposes but not secured by real estate? No, not any longer. The new HVCRE ADC provisions apply only to loans that are secured by real estate. And Greg kind of touched on this a little bit. And in the definition of what an HVCRE ADC loan is, the word primarily is kind of emphasized here a little bit. So if a major portion of your loan is not for HVCRE, so it's outside the HVCRE ADC classification, does the entire loan still need to be subject to these capital requirements? And the answer to that is no. Only if a portion of your loan is primarily finances, refinances, or has financed acquisition, development, or construction of real estate.
So what you're really talking about is a commercial real estate loan. That's really the stuff that you have to be careful about.
Correct.
Okay. So
correct.
Commercial finance loans.
Right.
Real
exactly.
estate's a small part.
Yes. So if only a minor portion of the loan is HVCRE, these provisions aren't going to apply at all, which is different than the way Dodd Frank was. If any portion of your loan was qualified as an HVCRE loan, then the HVCRE provisions applied, right? Okay, so what happens if cash flow becomes adequate to so you got your project, the cash flow becomes adequate to service the debt service and to also pay for the expenses? Do you have to redocument the loan to get this out of HVCRE provisions under Dodd Frank? Under Dodd Frank, you did have to redocument the loan. Under the new rules, all you have to do is reclassify the loan. Now, I say all you have to do. You do have to receive information that supports the reclassification. So there has to be substantial completion of the project, and then there has to be cash flow that is generated by that property that is sufficient to support the debt service and the expenses of that property as well. But it is no longer necessary for you to have the loan redocumented in order to reclassify or take the loan out of HVCRE provisions. Okay, so the next kind of question we thought might be asked is, do the new HVCRE provisions apply to loans for acquisition, financing, or refinancing to existing income-producing property? The answer to that is no. HVCRE ADC loans are only loans that are dependent on future income, sale proceeds, or refinancing in order to repay the loan. So does that make sense? Okay.
No, it doesn't.
Okay. No,
Aren't all loans dependent on future income or refinancing for repayment?
Well, no, not all loans are dependent. You could have cash flow currently. I mean, prior to the Regulatory Relief Act with Dodd Frank, you really didn't have income-producing property that was subject to HVC or EADC provisions. And this does allow for existing income-producing property, as long as that existing income-producing property is secured by a mortgage and produces cash flow sufficient to support the debt service and the expenses as far as the lender's underwriting criteria for permanent financing goes.
Okay.
Does that make sense?
That term income producing is right in the definition that the statute used. It was an add-in. It wasn't around in the Dodd Frank rules. So they specifically created this concept of looking at cash flow at the beginning when you're deciding whether the loan even gets in the definition in the first place, as well as later when you determine whether you can reclassify it and take it out of the definition. So that's always going to be a crucial issue, is looking at cash flow and looking at what's there and what the debt service requires.
Right. Okay, so this is also another sort of question that is probably going to be asked and has been asked already by some of the folks that we've talked with. What happens if the amount of capital in the project exceeds the 15% capital requirement? Under Dodd Frank, none of the capital could be taken out, even if there was internally generated capital that brought your capital up to 25%. You couldn't reduce that. You couldn't take distributions to reduce that to the 15%. However, under the Regulatory Relief Act, you can reduce that to the original 15%. That only the capital that is contributed by the borrower must remain in the project for the entire life of the project, or until the project is reclassified as a non-HVC or EADC loan under the statute. So internally generated capital is no longer required to remain in the project. It can be distributed out. So some of the loan documents that we have currently, if you do have that covenant that all capital must remain in the project until the loan is taken out of HVC or until the loan is repaid, those provisions may need to be revised. Now there may be other reasons why you may not want to release that capital, but that's an issue that you'll have to deal with your borrowers.
The rule wouldn't require that, but you could go that route.
Right. Right. Okay, and then Greg touched on this a little bit. This was the big punchline here. If real estate is contributed to meet the 15%, under Dodd Frank, that real estate was valued as of the purchase price because it was seen more as cash, not as capital, not as real estate being contributed. Under the Regulatory Relief Act, the real property or improvements that are contributed in order for you to get to that 15% are basically valued at the time of the appraised value as of the time of the loan. So you get the benefit of that increased property value. You don't have to just rely on the lower purchase price. You can look at the current appraised value under the as of the time of the closing of the loan. I think that's all that we have.
Do you have anything else, Hap, on your end?
You know, the only other thing I was going to ask on the 15% requirement, is it clear yet whether, say the bank requires, 20% equity upfront, can they reduce it to 15%, even though the borrower has put in 20% at the beginning?
You mean if the contract required 20%? The
Yeah,
loan
at the
document
beginning.
required 20%?
Right.
Yeah, I mean, under the new rule, at least 15%, okay, has to be retained. That's what the rule requires. If the bank contractually required more than that, it becomes a contract issue between the bank and the borrower,
right,
to figure out what they want to do with it. Okay.
It's a negotiating tool between the
The
banks
rule
and
wouldn't
borrowers.
require you to change it necessarily.
So the rule only requires 15%.
15%,
Okay.
right.
All right.
Right. Does anybody have, yes?
Yeah.
So I always want clarification of the 50%. When you're doing a construction loan, let's say you got a $20 million budget. A big chunk of that is soft costs, architectural, engineering, interest carry. And if your borrower puts in 15 or 20% of that, of the total project cost, which includes their 20% of the soft cost, it's still considered HVCRE because you have to exclude the soft cost? So in other words, are they only putting in their 15% of the hard cost, or does it be inclusive of all the soft costs?
Yeah, that's stayed the same, actually, the point you're getting at, which is development costs. That's the phrase that the regulators use. It was in the Dodd Frank rule, and it's roughly the same, I think.
It
I
is,
don't think there's any change
yeah.
really in the new law, so it hasn't changed. You are allowed to count towards that 15% capital requirement the payment of development costs. And there's a piece of guidance that came out under the Dodd Frank rule, which still should hold true. It should still work because, again, the language didn't change a lot. And it lists the kinds of things that the regulators think counts. Okay, so there might be some things that go a little further afield than what they would say. I wish I could recite off the top of my head what the list was. It's a short laundry list of 7 or 8 things that they say, if you're within these categories, you're fine. So there are several kinds of what you might call soft costs that are included. And I can show you that that laundry list after we get done here. I don't want to waste everyone's time looking at it now, but it's fairly descriptive about the kind of things that you'd look to. And yes, they can be used if they're on the list. Other questions? Yeah.
The appraised value under the new rule, is that still as complete?
Yes, that has not changed. That portion of the rule has not changed. That stays the same.
Well, which appraised value are you talking about? Are you talking about real estate contributed to meet the 15%?
Yes,
Okay.
that stays the same.
Yeah, you use the current appraised value for the real estate. Okay, because again, we got 2 different things
Right.
here. We got 2 different appraisal sets. You've got the appraisal of the project being financed in the end. Okay, that's to calculate your 15%. You use the as completed value of the project at the end. Okay, that's one appraisal, and that's how you calculate what is 15%. The other is if you've got some land you're contributing, right, and you're going to figure out, well, what's that worth that can go toward the 15% to meet it.
That's as is.
And that's as is.
That's as is.
Exactly.
Right.
Right. Yes.
For the cash flow adequacy requirement that you mentioned, does the cash flow have to be enough to meet the debt expense 1:1, or does it have to be a certain multiple of the?
You know, the Dodd Frank, there's more than one reference to cash flow in the new Dodd Frank rules. I think in each case it refers to the bank's underwriting standards typically used. So you're going to look to your bank's underwriting standards, which obviously are going to be subject to scrutiny of the regulators anyway, but you're going to go by those standards that you already have in place for your commercial loans. So that's
For
the kind of
permanent
ratio.
financing of the commercial
right,
loans. Right.
for permanent financing. Yeah.
Right.
Yes?
Is risk-based capital still 150%?
Yeah, that's a great question, because there's a longer answer than you might think. It is right now, yes. It is currently. In late 2017, the regulators floated a proposed rule to update the Dodd Frank rule. Okay, the proposed rule never became effective. In fact, it was still hanging when the new statute went in place this spring. So in that proposed rule, the regulators said, let's change it from 150 to 130. So the reason I say it's a good question is because when the regulators go back to the drawing board and they start looking at it, incorporating all these new standards, there's a really good chance they'll go back and say, well, we said before 130 was okay for this real estate. They may do that again. Now, the fact that the statute has whittled down the definition of what's included could impact that some, because they might have said 130 was okay before because we were including a lot of other loans in here. But I think that's something to look for. There's a very good chance they drop it down to 130 again on that basis. Yeah.
In a much more broad sense, do you have any insight into additional changes with respect to Dodd Frank in general beyond HVCRE? Just what's next? What else is being discussed?
Well, that's a pretty broad question.
You take that one, Greg.
It's about a 1,000-page law. The law from May that we're talking about now, the EGRCP, whatever it is, that law, it is not just about HVCRE. It's a bigger law than that. In fact, there are a variety of Dodd Frank rollback provisions in that law, and I won't go into those now. But our firm has written a series of articles about those changes, and it's specifically targeting not just the law itself, but the Dodd Frank rollback aspects of the law. So we have a blog called Bank Check Blog, and if you go online, you can read, there's 3 articles, I think, that break it out into categories of things in Dodd Frank that have been rolled back by the new law. Most of it's already effective, too. Most of that law went into effect at the time it was done. There's a few that are pending regs. So that's one thing, and so there already has been some items addressed that are Dodd Frank rollbacks. There's also a lot of talk with the regulators currently about things that can be done by the regulators to roll back Dodd Frank things, too, that don't need a statute, right? So You've heard a lot of talk with AML, working on customer identification program requirements and scaling that back. You've heard some talk about some CRA stuff. Some of that is, and some of that isn't Dodd Frank, but there's been a movement. I guess the Volcker rule is another one. There was some Volcker rule stuff in the statute from May that rolled that back for some smaller banks. But I think the regulators are looking hard at ways they can pass regulatory changes without having to go to Congress and change more things. So I'd say stay tuned on more changes. Take a look at the blog articles we've done about stuff that's already been done, but there should be more regs coming out in the next months. We've got now, the new administration has their people in place, the Fed, FDIC, and OCC, so you're going to probably start seeing more movement on that. Yeah?
How is this going to be impacted by the midterm elections?
Hap, I'm going to turn that one over to you. It's hard to say because obviously if Congress changes, you might have a rollback of the rollback. I don't know. I mean, that could happen, right? So it's hard to say. It depends probably on how strong the change is. If it's a supermajority or something like that, it could make a huge difference. I don't think anybody knows for sure how that's going to go and what change it would mean. It'll take some time to filter out because that just affects congressmen, right? You still have the same president, therefore you still have the same regulatory people. So the approaches and the reg changes are probably going to continue as they would have. They may get more difficult questions asked to them in front of Congress. That's very possible. But that's just a wait and see thing. We'll just have to check. I think if there's turnover, are you going to see far less in the way of legislative activity that would be considered rolling back Dodd Frank? Absolutely. I mean, there's not going to be much of that if the Democrats control both sides of the House and the Senate. Any more questions?
Anybody else?
I guess we should mention, because I did talk to a couple folks before the seminar started. If you have anyone that wasn't able to make it today, we will have a link that'll be available that will be able to provide you with all this information, so you can rewatch it at your leisure.
Yeah. Despite our protestations, they're filming this, so there'll be some sort of audio and/or video feed that's available, and we're going to try to make that available. On the website, and maybe even issue something out to clients that lets you know when it's out there and how you can access it, that kind of thing. So
Right,
you can roll it back
free.
and watch us and pick apart what we said.
Or you can feel free to email either Greg or I or Hap,
Yeah.
and we can get you that link.
That would be fine too.
Okay.
And we'll hang around too for questions afterwards. We've got a few minutes left. Anybody that wants to ask anything, we're happy to hang around and answer.
Okay. Greg and Gayle, thank you very much. Great presentation.